Welcome to session 2.6a, which can be found in module 3, everything you ever wanted to know about the cash flow statement. We're going to be looking at the cash flow statement in its most common presentation, which is the indirect method. And it's also very similar to what you're going to be doing for your homework in this area. So let's get started. Today is the cash flow from the accrual financial statements, and we're converting cash flow, net income to cash flow from operations using the indirect method. All right, so on the income statement, we have accrual-based revenue minus expenses equals net income. In the first part of the indirect approach to the cash flow statement, we are going to convert that accrual-based net income, where revenue is recognized when it's earned and expenses are matched or follow those revenues, and we're going to adjust it by non-cash expenses that are found on the income statement, plus or minus the changes in current asset and current liability accounts to give us cash from operating activities. In other words, we're going to then know how much revenue was recognized when cash was received and how much the expenses were as they were incurred and paid for in cash. So here we go. This may look familiar because if you did the pre-work, you found the important numbers in the consolidated statement of cash flows for Amazon, and you found them for 2015. You could also notice they changed the direction, find them for 2016, which is here, and then Amazon became Alphabet. So for Alphabet for 2018, here, we can find our cash from operating activities, and notice the 2016 numbers for Alphabet are different from the 2016 numbers for Amazon, and that's because they have more companies mushed together. That's what consolidated means, that they've summarized a variety of companies that they own. We can find the investing activities here, and we can find the financing activities here. So notice the format hasn't changed. We're still finding operating, investing, and financing activities, and we find the net change, and you add that to beginning cash to come up with ending cash. So that is, the format has stayed the same. The finding of the numbers has stayed the same. What's interesting about this cash flow statement, if you look at operations, it's what are the biggest numbers? Well, there's big numbers that depreciation, so that depreciation is a large expense, and remember, depreciation is a non-cash expense. And the other thing that's big is stock-based compensation expense, which means those are the deferred stock options that they're not paying out in cash right now, but will probably in the future. And also that we have big accruals, which is also interesting. Oh, and look at this one. Gain loss from debt equity securities. This is because, as we'll see in investing, so if we look at the big numbers in investing, notice that the biggest number is the purchase of marketable securities. So you could say to yourself, well, what does Amazon really do? Well, it's an investment company that buys and sells investments and these are long-term investments because they're down in the investing section, but it's showing you that they have a lot of cash around. What else do they have? They've got maturities of marketable securities and a lot of purchase of property, plant, and equipment. When you look down at the financing activities, they're pretty small, and they repay debt, and they buy back their stock. So what a cash flow statement allows you to do is it shows you where the company is really putting its money. So, you're saying put your money where your mouth is. This shows you how they're actually using their money, their cash, for their business or spending their cash for the business. So what are the steps for doing an indirect method? Number one, that you want to find the answer. And the answer is the change in cash between the beginning and ending cash account on the balance sheet. Once you know that answer, you know where you're headed. So begin with the end in mind. The second thing you'll do is you'll look at the income statement for any non-cash expenses, things like depreciation expense, amortization expense, gains and losses from the sale of equipment, and all of this goes into the operating section. Then you analyze the changes in your current assets and current liabilities, and those changes also go in the operating section. So what goes in the operating section? Changes in current assets, current liabilities, and the non-cash transactions found on the income statement. This is very similar to what we did in the direct method. Then, going on to the investing section, you're going to analyze the non-current asset accounts, and what happens there goes in investing. And we're going to analyze our long-term liability accounts, and what happens there goes in financing, and then we'll analyze contributed capital in the retained earnings accounts for what also goes into the financing section. Now, the direct methods investing and financing section is exactly the same as the indirect methods investing and financing sections. So they are the same. Investing, financing, whether you do it the direct method, the indirect method, they look the same. They have the same information. The change or the difference is found in the operating section, because under the indirect method, you're basically taking the accrual-based net income and converting it into cash from operations or operating activities. So let's try one. Here's a company, tells us a whole bunch of information up here. We're given an income statement, and cruising through the income statement, I can see I have a non-cash depreciation expense. I also have a loss from the sale of the equipment to come up with net income. So this is going to be the top line on my operating section, that my net income is where I start that cash from operations, and then I will adjust back. So let's think about this. If we had a loss, that loss reduced my net income. Since we're talking about non-cash, we're going to add that back, that loss. So losses you add back, gains you subtract. Depreciation, since depreciation reduces the net income, we'll also add that back. All right, so those are the things there. Let's see what the balance sheet shows. On the balance sheet, I can find my answer. So my change in cash, I began the year at $20,000 in cash. I ended the year at $167,000. So the change, or what I'm looking for, is a $147,000 increase in cash. My accounts receivable went down $20,000. Now, if accounts receivable go down, the only way they can go down is if your customers pay, which means your cash is going to go up. Inventory went down, is that 40,000? And if inventory goes down, the only reason inventory can go down is if you sell the inventory. And if you sell the inventory, that means cash is going to go up by 40,000. Prepaids is another current asset. It went down 400. And if your prepaids go down, that must mean your cash goes up. So you see that current assets have an inverse relationship to cash. Property, plant, and equipment, accumulated depreciation, is a long-term asset, so we'll analyze that for the investing section. Looking at our current liabilities, we have accounts payable. Accounts payable went up 22,000. So if the change is 22,000 and I have more accounts payable, that means I haven't paid the bills and I still have the cash. So that means the cash on the cash flow statement will go up 22,000. Notes payable went down 50,000, and the only way a note payable can go down is if you pay the note. So that means cash went down 50,000. And income taxes payable went up 8,000. So I owe more income taxes, so I still have my cash, so my cash increases. So notice for my current liabilities that there is a relationship that goes in the same direction as the increase or the decrease in the liability. So the next step, since we now know the answer, 147,000 change in cash, we know the changes in our current assets are changes in our current liabilities. The next thing to do is to analyze my long-term assets, my long-term liabilities, and my shareholders' equity accounts. So let's see what happens. All right, so property, plant, and equipment started the year with a beginning balance of $552,000. It ended the year at $628,000. We know that property, plant, and equipment is increased when we buy it, and it is decreased when we sell or dispose of property, plant, and equipment. Our additional information tells us that we bought $100,000 of property, plant, and equipment, which means that we disposed of property, plant, and equipment of $24,000. So if I disposed of it, here's my disposal entry of PP&E. I know that $24,000 is the amount that property, plant, and equipment was reduced. Looking at accumulated depreciation started the year at $140,000, ended the year at $183,000. I also know from the income statement that my debt entry was $60,000, so the depreciation on the disposed of equipment was $17,000. So I know that because I'm good at CSI accounting. All right, so I've reconciled everything that happened in property, plant, and equipment and accumulated depreciation this year. So what I'm interested in is how much cash did I receive when I sold that property, plant, and equipment. Well, the income statement also told me that I had a loss on the sale of $4,000. So the amount of cash that's going to show up on the cash flow statement from the disposal of property, plant, and equipment is the difference, or $3,000. So that's an important thing. All right, so cruising down to mortgage payable. Mortgage payable started the year at $280,000, ended the year at $360,000. Our information told us that we borrowed $100,000 to buy that new property, plant, equipment. So I must have repaid $20,000. So I need to remember this and this, that I borrowed $100,000 and I repaid $20,000 when I do the financing section of my cash flow statement. Common stock didn't change, so I didn't have to look at it. Retained earnings started the year at 153, ended the year at 212,600. I know from my income statement I had net income of 119,600, which is the first line on my cash flow statement. So I must have paid dividends of 60,000, and I'll need to remember that because that was a use of my cash during the period. So I've analyzed all my accounts, I found all their differences, and now it's time to do the cash flow statement. So as you see, we start with the net income from the income statement. The change in the depreciation expense was from the income statement, and the loss on the sale was all from the income statement. Then we analyzed our current assets and current liability changes. And we talked about that current assets, it's an inverse relationship. So if accounts receivable or inventory or prepaids go down, that means we add in. And if they're current liabilities, they go in the same direction as the change. So cash from operations is $224,000 from the accrual-based net income to the cash-based net income. As far as the investing, by analyzing the property, plant, equipment, and accumulated depreciation accounts, I figured out that I bought equipment, and $100,000 went out for new equipment, and I found the cash proceeds from the sale of the equipment was $3,000, not the loss, not the gain. So netting that, cash from investing activities was an outflow of 97. Then I figured out my financing because I borrowed $100,000 to buy that equipment. So that's a source of financing. That was the change in the long-term debt. I also, from my analysis, figured out that I repaid $20,000, and then analyzing retained earnings, I figured out I paid dividends of $60,000. So a change from financing of $20,000 inflow. And adding and subtracting those operating, investing, and financing, I find that the change in cash is $147,000. And if I wanted to do this beautifully, I would add in the beginning cash balance to equal the ending cash balance. So that is an example of how to do a cash flow statement, the indirect method. So you've done one. Go on to the second part of this, and you will get to do, I think, 3 more problems, which should get you in great understanding in order to do your homework. Thanks so much.